Here is a number that should stop you in your tracks. Analysts are now warning that oil could hit $200 a barrel this summer. Not because of speculation, because of data. The Iran war has pushed U.S. oil inventories to their lowest level since 2004. That is a 22-year low. Iran's crude exports are collapsing under the U.S. naval blockade. Developing nations are already experiencing what the United Nations is calling catastrophic impacts from the disruption in the Strait of Hormuz. And OPEC's technical committees just concluded emergency meetings in Vienna ahead of a critical ministerial meeting on June 7. Tonight, we break down the full picture of the most severe oil supply crisis in a generation and what it could mean for your wallet, your country, and the global economy. In the next 7 minutes, we are going to give you the complete energy crisis picture. We will cover why U.S. oil inventories have dropped to a 22-year low and what analysts at the Financial Times and Rystad Energy are saying about the $200 risk. We will break down how the Hormuz disruption is hitting developing economies hardest. We will look at Iran's collapsing crude exports and the U.S. blockade mechanics. We will examine what OPEC's June 7 ministerial meeting could decide. And we will explain what the surprise in the story is, because it is not all bad news for everyone. Subscribe and let's get into it. The data trail begins building on June 1, when Rystad Energy flagged a key analytical question: could Iranian oil become the biggest energy story of the decade? Their analyst Aditya Saraswat discussed Iran, Hormuz, disrupted supply, and what a post-sanctions future could mean for global energy, a question that seemed speculative at the time and now looks prescient. By June 2, Energy Intel was tracking a concrete operational development. Loadings at Iran's Jask terminal had stepped up to record volumes, but the U.S. naval blockade had slowed flows at Karg Island, Iran's primary crude export hub, to a trickle. According to posts from at Energy Intel, with minimal flexibility to switch terminals, Iran's crude exports are collapsing. That same day, the OPEC Economic Commission Board concluded its 145th meeting in Vienna, producing technical inputs for what OPEC's secretariat confirmed would be the 193rd OPEC conference and 41st OPEC and non-OPEC ministerial meeting on June 7, 2026, a gathering that now carries extraordinary market significance. By June 3, the United Nations was publishing UNCTAD data on the Hormuz situation, stating directly that vulnerable economies are bearing the brunt of disruptions in the Strait of Hormuz, with surging oil prices pushing up costs across transport, supply chains, and energy markets, with what UNCTAD characterized as catastrophic impacts on developing countries. Energy Intel's broader analysis noted that while the Mideast conflict has boosted revenues for most oil and gas producers, it has also created new uncertainties, suggesting it may not portend another investment supercycle. Then, in the early hours of June 4, Cointelegraph published its most alarming data point of the cycle, reporting that Trump's Iran war has pushed U.S. oil inventories to their lowest level since 2004, with analysts warning prices could hit $200 per barrel this summer, citing Financial Times analysis. The Hill confirmed separately that research is projecting a prolonged energy disruption from the Iran war would be a severe blow to the global economy. On the same morning, Al Jazeera English reported breaking news that Indonesia's rupiah had reached its weakest level ever against the US dollar, a concrete example of the emerging market currency stress that Hormuz-driven oil price pressure is generating across vulnerable economies. The first question many viewers are asking is a $200 per barrel oil price actually possible, or is this analyst speculation? The short answer is that the $200 figure is a tail risk scenario tied to specific conditions, not a baseline forecast. For context, global oil markets have historically shown that supply disruptions of 5% or more sustained over multiple months can produce nonlinear price spikes that models fail to capture. The U.S. naval blockade has effectively choked Iran's primary export route at Karg Island, which normally handles the vast majority of Iranian crude exports. Iran's attempt to reroute through Jask on the Gulf of Oman circumvents the Strait of Hormuz but has limited pipeline and terminal capacity. Energy Intel notes the Mideast conflict has boosted revenues for producers, meaning Saudi Arabia, the UAE, Iraq, and U.S. shale operators are all benefiting financially but creating uncertainties that may not sustain a new investment supercycle. This is where Rystad Energy's chief economist Claudio Galimberti adds a critical counterpoint. High prices are triggering a U.S. shale response that the market did not see coming. He characterizes a potential outcome where the largest oil crisis in history may end in energy abundance because the price signal is already activating American producers at a scale that could eventually flood markets. A second pressing question is, who gets hurt most and how quickly? On that front, the UNCTAD data is unambiguous. The Strait of Hormuz carries approximately a fifth of global oil trade. Developing economies, particularly in South and Southeast Asia, Sub-Saharan Africa, and Latin America, import the majority of their oil rather than producing it. When transport and energy costs surge simultaneously, the cascading effect on food prices, manufacturing, and government debt servicing can be immediate and severe. Indonesia's rupiah hitting an all-time low against the dollar on June 4 is a concrete leading indicator of this stress already manifesting. Is a $200 per barrel oil price actually a realistic scenario, or is this pure analyst fear-mongering? The figure is credible as a worst-case scenario if the Hormuz disruption intensifies or if OPEC Plus does not meaningfully increase production at its June 7 meeting. However, Rystad Energy's analysis suggests U.S. shale producers are already responding to the price signal in ways that may eventually flood the market, meaning the crisis could accelerate its own resolution through supply-side response, possibly before prices reach that extreme level. Who gets hurt most by rising oil prices, and how quickly does the pain spread? Import-dependent developing economies in Asia, Africa, and Latin America are already absorbing catastrophic cascading costs, as the UNCTAD report documents. Indonesia's all-time rupiah low on June 4 may suggest currency stress is already outrunning central bank interventions in the most exposed markets. Wealthier oil-producing nations and U.S. shale operators, by contrast, are benefiting from the same price surge. In the United States, the immediate consumer impact of a 22-year oil inventory low is likely to show up first at the gas pump and in aviation fuel costs. The Trump administration sanctioned Iran's largest digital asset exchange on June 2 as part of what it calls economic fury, a signal that economic pressure on Tehran is being applied in parallel with military pressure. But the domestic economic cost of higher energy prices is real. The Federal Reserve's Beige Book, published June 3, captures economic conditions across all 12 Reserve Bank districts, and energy price pressures are a consistent theme in the districts most exposed to industrial and transport costs. Across the oil-producing Gulf states and Middle East, the financial windfall from elevated prices is substantial. Saudi Arabia, the UAE, and Iraq are all accumulating revenues that strengthen their fiscal positions, but the uncertainty about conflict duration is making long-term capital investment planning difficult, according to Energy Intel's analysis. For developing economies, particularly in South and Southeast Asia, the pain is immediate and compounding. Indonesia's rupiah is already at an all-time low. Import-dependent economies across Sub-Saharan Africa and South Asia face a toxic combination of surging import bills, weakening currencies, and rising government borrowing costs. Australia is moving to protect its domestic market, announcing a policy requiring LNG exporters to reserve 20% of their exports annually for the domestic market, a direct response to the global supply disruption. In Europe, the IEA updated its energy crisis response tracker on June 3, and the IEA executive director met with the Greek finance minister, who serves as Eurogroup president, specifically to discuss Middle East energy security risks and the possible scenarios ahead. To be fair, there is a compelling counter-narrative emerging from the energy markets that deserves full attention. Rystad Energy's chief economist Claudio Galimberti has made a provocative argument: the largest oil crisis in history may end in energy abundance. His thesis is that the price signal from elevated oil already above levels that make most U.S. shale projects highly profitable is triggering a production response from American operators that the market did not anticipate. If shale producers ramp up at the scale suggested by current economics, the supply shock could be self-correcting within 2 to 4 quarters. There is also a legitimate argument that the $200 per barrel figure, while analytically defensible as a tail risk, is a worst-case scenario that assumes no OPEC Plus supply response, no meaningful ceasefire progress, and continued blockade intensity, a combination of events that may not all materialize simultaneously. Energy Intel's own analysis acknowledges that the Mideast conflict has already boosted revenues for most oil and gas producers, which creates financial incentives for producers to support market stability rather than allow a price spike that could accelerate the global energy transition and destroy long-term demand for fossil fuels. Some analysts also point out that California natural gas prices actually hit historic lows in early 2026, suggesting that even within the U.S. energy market, the picture is not uniformly bearish for consumers. Here is the kicker: the same oil price surge that is devastating Indonesia's currency and pushing developing nations toward economic crisis is also generating record revenues for Gulf state producers and making U.S. shale wells that were marginal 6 months ago suddenly very profitable. 1 crisis. Completely opposite outcomes depending on which side of the supply equation you sit on. Drop your read in the comments. Do you think oil hits $150 or higher this summer, and are you personally already feeling this at the pump? We read every single comment.